So for today's presentation, we're going to kind of do an overview on a solo 401k and then how to use that solo 401k to purchase real estate investments and property. So one of the great things about the solo 401k is it is a very good at saving taxes. It's a very good tax advantage retirement account for self-employed business owners and their spouses who are the only employees at that company. But it's not just limited to people who are self-employed. You can also have a solo 401k if you have earned income from a side hustle, from real estate investment, or just from another job where you do consulting. So you can have a solo 401k through your W-2. You can have a 401k through your W-2 job, but you can also have a solo 401k on your app as well through your side gigs, which is nice. So, and what's good about that is if I go to the next screen here, what is a solo 401k? It is basically the exact same thing as a solo 401k that you get through your work, but there's more features to it. And those features are, it allows you to invest in more assets. So a solo 401k through your W-2, through your work, you're kind of stuck with like stocks, bonds, mutual funds, while solo 401k, it kind of opens the door to you to be able to invest in other items besides those, like real estate, where you can purchase property. And that's what the last half of this presentation will be on, is how to use your solo 401k to buy property. You can buy crypto, you can buy gold. So solo 401k is pretty advantageous to those who want to put money away in today's dollars to lower their tax bill, but then also be able to invest in more products than just the original through your work. So another nice key feature about solo 401k is it allows you to contribute in two ways, as an employee and an employer. So just like all solo 401ks, the employee, you can donate or you can contribute pre-tax, if you choose a pre-tax solo 401k, $20,500 of your own employee earnings. That will lower your W-2 wage, that will lower your income by about that $20,500 if you max it out. If you're over 50, you can do a catch-up contribution of $6,000, so you can do about $26,500. That usually grows about $1,000 to $2,000 a year of your contribution. But the caveat for a solo 401k is you can also do the employer contribution. So the employer contribution is a percentage of net profits for your company. So if your LLC had a significant income through rental properties or just flipping land or other types of consulting services, you could contribute your $20,500 as the employee, and then about 25% of your net earnings. The combination of the two cannot add up to more than 61,000. So, for example, if you had 150 some thousand in profit, you could put 61,000 into the solo 401k account tax free and lower your tax burden by a pretty decent amount. If you have a spouse that also works for that company part-time, they are also able to participate in the solo 401k, and you can double that annual contribution up to about over 100,000. So you can do depending on income limits of the business, you can almost put over 100 and some thousand away tax-free into a solo 401k. While 401k through your work, you're limited to that 20,500 plus whatever your company matches, 3, 4, 5% of your salary. That's one of the big differences between the solo 401k and other saving mechanisms out there, is you have that really high annual contribution limit. As a solo 401k, you are the person who's in charge of managing the funds. So you get to decide, what do I want to invest my funds in? You know, do you do stocks, bonds, do you do an exchange traded fund, or do you buy a property and houses that you want to invest in? So you're the manager. You're not relying on some fiduciary to pick the stocks for you. You kind of have the control. And again, if you do have an existing 401k from a current W-2 job and you're retiring or you're switching careers, you can roll that 401k into a newly created solo 401k, or you can have them both separate. So you can have more than one you can have more than one 401k, you can have a work one, you can have your solo one. There's really no age limits on having a solo 401k, you just have to have income and have it set up properly. So common myths, kind of talked about this a little bit earlier. You can have more than one retirement account. It's legal too. You are able to invest your money. Again, you are the fiduciary. You are able to decide what investments that you want to put your funds in. When it comes to retirement, you could think that, oh, I don't have enough money in retirement or in the solo 401k. As you'll see later on, to buy a property, you don't have to have necessarily 100% of the funds to buy the property. You can get a loan through the solo 401k to buy the property. And we'll go into a little more detail into that later, but you can leverage. Again, age, you're never too young to start retiring, even if it's $1,000 a year. The earlier put the money into the account, time value money, the returns you're going to get on it over time, it's just going to keep growing. So whether you have kids or you're earlier on in your career, always think about retirement. Some money's better than none. What's nice about the solo 401k is, as we were discussing earlier, how you can put almost up to 61,000 as an individual in, it really lets you grow your net worth, because as you put funds into the solo 401k, you're lowering your taxable amount. So you're not paying that much money in taxes in the current year, and your solo 401k gets to earn money in return. And all that is tax-free while it's in the solo 401k. You don't pay taxes on any of those earnings until you start taking distributions, which hopefully is around 59 and a half or older. So you can grow your net worth very rapidly. Again, you can roll your retirement accounts over. The main thing when you do that is you want to make sure the custodian of your current 401k account wires the money to the solo 401k account that you create. You never want to take cash and then put it in, because that could look like a distribution from the IRS where you may have to pay taxes. You can also roll your 401k account into a solo 401k Roth if you choose. You will have to pay some conversion taxes, but we can manage that, and we can do a plan where you do partial conversions from your solo 401k from your 401k to a Roth solo 401k to help you mitigate taxes. So that's pretty helpful. It doesn't have to all be done at once. And then the solo 401ks are pretty easy to manage. You have to do a yearly statement for your tax form for the CPA, which isn't very difficult. And then when you get over 250,000 in the account, there's just one single tax form that your CPA yourself will have to fill out. But it's very basic. It's not too complicated on how to manage. Is a solo 401k right for you? That's more of an individual question. Some people may not be far enough along in their business process to where they're having a lot of profit from their side gigs or rental real estate, to where a solo 401k just may not be worth it. But some individuals could be to that point now where, hey, they don't want to pay this money on the taxes that they're earning, and a solo 401k is a great way to lower your tax bill and lower your savings and create wealth. So solo 401ks, even though we're towards the end of the year, as long as they're created and set up by 12/31 of the year, you can fund them in 2023 until you file your taxes. So if you have a solo 401k created, have the EIN, have all the signatures and everything done by, let's say, 12/15, but you don't know your profit on the business, you don't really know the employee portion that you want to contribute till January or February of 23. For tax purposes, we can still fund the solo 401k in 2023 and lower your 2022 taxes. So if this is something that you would think could help you lower your 2022 taxes, it'd be a good idea to reach out to me at Royal Legal Solutions or Scott, or just reach out to the team to determine if a solo 401k is right for you to help you save money in the current year. If not, we can always plan on setting one up in 2023 if you think that's when you'll cross the threshold of wanting a solo 401k. And then instead of doing large cash distributions at the year end, you can do them weekly, bi-weekly, monthly, or quarterly as needed, whatever you're comfortable with on a cash flow standpoint. So I'm sure many of you have seen this iteration before. Right here, we're talking about today is the tax strategy, and the solo 401k is a very good part of building your wealth creation and financial freedom. And being in a solo 401k, it does protect the assets. Most of your states and the federal government with savings accounts and retirement accounts, they're pretty well guarded from any asset liability or protection. But again, it's just being able to put money into the retirement account and save on the taxes has really helped build the net worth and allow you to do investments. So big part of wealth creation is properly doing your tax strategy and having that set up. I'm not seeing any questions yet for the solo 401k, so I'll talk about how to purchase property with a solo 401k. To buy real estate with a solo 401k is pretty much the same way as you would buy it personally, except instead of having your name on all the title and all the paperwork, it's going to be the solo 401k. So first step to purchase property with a solo 401k is you have to have a self-directed solo 401k open. And what that is you have to have an EIN established, you have to have plan documents signed, and in those documents, you have to have the ability to invest in other assets like real estate, crypto, gold. Royal Legal Solutions does offer solo 401ks, and all of ours do offer those options. So there would be no problem there with us. You have to fund the solo 401k. So again, you can fund the solo 401k various ways. You can contribute dollars to it every paycheck, every quarter, once a year. They could be the employee portion, the employer contribution portion of the profit. You can do your rollovers from your simple IRAs or other 401ks. Those do take a little more time, depending on what branch or what area or what company you're using from. They could take anywhere from a couple of business days to 10 business days. So we usually say 5 to 10 to plan. Probably with the current environment, it'd probably be closer to 10 days if you were to try to do these distribution and direct rollovers towards the end of the year. The biggest part you're going to have to do when you go to buy real estate with a solo 401k is determine what method that you're going to use to purchase the property. So there's 4 methods to purchase property. One's in essence an all cash method, where your solo 401k has enough money in its account to just 100% outright buy that property. The other is called debt financing. So you would go to a bank, the solo 401k would get a loan for X amount of dollars to help purchase the rest of that property, just like you would as a buyer. And a third option is LLC buys the property, but the LLC is in the solo 401k. So in essence, the LLC buys the property, it owns the property, but it reports to the solo 401k. This is done as an extra layer of that asset protection. So anything related to that property just sticks with that LLC and does not filter out into the rest of the solo 401k. And then the fourth way to purchase real estate is tenants-in-common. So that would be, in essence, you're partnering up with someone. So I have 50% of the purchase price through my solo 401k, and then I take a partner on that buys the remaining 50%. That could be me as an individual, or it can be a third party, it can be a business partner, so forth. Those are the 4 main ways that you can buy property in a solo 401k. And I'll get into a more detailed example here later on with those, but I just want to let you know that those are the 4 main ways. So after you decide which method you're going to buy the property with, you then put an offer on the property. And by putting an offer on the property, you're in essence writing an offer and submitting earnest money. And earnest money comes from the solo 401k. You will write a check out of your solo 401k for the earnest deposit. And then hopefully the deal gets closed, and then you go to closing, and at closing, you as the trustee of the solo 401k, you'll sign all the documents for the solo 401k. The solo 401k does own the property, so everything you sign will be blank doe of trustee blank blank of solo 401k. So the solo 401k owns it. It's not under your name, but you will be signing for it as the trustee. So going back to the methods, when you do buy real estate, you can't buy it from certain individuals. In essence, if you were to own a property, you can't sell it to your solo 401k. You're a disqualified person. They won't let you double dip on that. If your solo 401k wants to buy a property from your brother, sister, children, or parents, you also can't do that. Those are disqualified. Those transactions are not allowed under purchasing a solo 401k, purchasing property under a solo 401k. You are able to, though, buy property from your mother-in-law, but because they're not considered a related party at that point. So that's kind of the first hurdle that you want to look at when you are looking at properties, is you can't really be connected to anyone. All right, sorry. So the other one of the number two options, and this is probably one of the more common ones when you're first starting out, instead of doing the all cash offer, is doing the debt financing. And when you use a bank to buy a solo 401k, they're a little more stringent on the loan to values that they will give you. So for example, if you're wanting to buy a property, the loan to value, they're probably going to only loan you is the 40 to 60% of the value of the house. So you're going to have to come up with a decent amount of cash to be able to purchase that property. The banks want a little more collateral when they're doing loans for solo 401ks. And when you do purchase the property, again, it's the solo 401k. The solo 401k, they're the ones that have the debt obligation. You can't, as the individual, have any debt obligation for that loan from the bank. It's all must be done through the solo 401k. The solo 401k is the person that's on the hook for the loan. You have no recourse as the individual. So that's why the banks do require more money down. And again, the loan to value is 40 to 60%. You can maybe get up to 70% loan to value from certain banks, but in today's markets, they may be a little tighter. When you do go in to buy a loan with a bank through a solo 401k, though, the lender will not review your credit because it's not you buying the asset, it's the solo 401k. So just the 401k plan balance is what's looked at when they make that determination. In other instances, when you would buy rentals, let's say as a personal rental, or you buy rentals outside of solo 401k and you use debt to finance it, you sometimes get hit with unrelated debt finance, where you have to pay taxes on income earned on the property that you have financed via debt. In solo 401ks, you don't have UBIT taxes. You won't have to pay any of those taxes. So that's another kind of savings that you can use through a solo 401k. When you do a loan, or when you do buy property with a solo 401k through a bank, they do have those disqualified persons lists that I mentioned earlier: your spouse, your parents, your children, adopted children. So again, you're having to look for third parties, arm reach transaction. Then kind of the third way is the tenants in common. So again, high level tenants in common, it's just like buying a rental with a partner, except your partner can be yourself. You can have your solo 401k be a partner, and then you yourself can be a partner, and you can buy the real estate. Key thing is, when you do buy that, you'll want to have an operating agreement, and then you got to define the percentage split. So my solo 401k owns X percent, partner A owns X percent, I can be partner A, whoever can be partner A, or tenants in common. And that's how all money will be distributed and all bills will be paid, is based on that split, or the tenants-in-common purchase. So once you have bought the property, you're like, okay, what's next? What do I do? So when you buy the property, who pays the bills? The solo 401k does. So any expense should be paid from the solo 401k bank account. So big red flag is never pay anything for a solo 401k property out of your personal account. By doing that, you could be commingling funds and could trigger prohibited transactions, and those prohibited transactions could cost your solo 401k, or it could also create a taxable event. So anything that you have to pay, property taxes, HOA fees, insurance, repairs, maintenance, utilities, you'll want to pay all that through the check account at the solo 401k bank account, never your personal account. And frequent expenses, your legal setup costs, if you're having to do remodel costs, again, you want to put those all out through the solo 401k. But those higher end costs that are more money, those could be capital, and you'll want to definitely bookmark those and show those to your CPA so they can determine whether you can expense those through bonus depreciation, or if you're going to be able to depreciate it over shorter lives, depending on the asset type. So just like when you pay bills, when you receive income from this rental or from the properties, again, that goes directly to the solo 401k account. So all checks that you receive, any refunds of closing fees paid, all those need to be deposited in the solo 401k account, not in your account. If you put it in your account, it'll create a taxable event and you'll have to pay taxes on that income. Again, if you were to distribute, if you were to, let's say, pay a personal check for a repair for your solo 401k property, then you're like, oh, I'll just write a solo 401k check money out of that to reimburse me. Well, that's considered a taxable event. So you're going to have to pay taxes on the amount that you were dispersed out of the solo 401k to you, and you're going to have to pay a 10% early withdrawal fee. So again, never mix the funds. Anything with a solo 401k property, use the solo 401k check account. Okay, great. All right, so after you bought it, we kind of want to list some best practices in managing your solo 401k property. If you own the property through your solo 401k, you cannot live on it. This property, that's a prohibited transaction. You can't even rent it or even be on a short-term basis. And this also goes to your immediate family members as well. So your parents, grandparents, children, grandchildren, they're also prohibited from living or renting on the property, even on a short-term basis. The next bullet point I have, it says, don't perform any work on the property yourself. Technically, you could do some work on the property. I just recommend not performing any work on your property, because that gets back to, oh, am I commingling funds? I'm going to go to the store. Do I just buy the product here with my own cash and try to reimburse myself? It's just easier to pay someone else to do all the work for your property. One of the things you'll see online is, when it comes to solo 401k, do the white collar work, which means pay the checks, deposit the cash, do all the office clerical work. And then all the blue collar work type activities where you're actually having to replace light bulbs, stuff like that, you just pay someone else, is what they kind of recommend. As you can see, the next bullet point talks about hiring unaffiliated third parties to perform any repairs. Even if it's a business of your son or daughter or a disqualified person, you can't use them. You always have to use people that are not disqualified, or they got to be qualified people, which means they really just can't be immediately related to you. And then you can hire, we do recommend as a best practice to hire an unaffiliated third party to be your property manager. That does increase some costs, but again, it just has that arm's length transaction where someone else is kind of performing the work. You're not performing any work on the property. But you can technically do property management yourself. It's just a best practice is to have someone else do that for you. Your solo 401k cannot purchase property you own personally. So as we discussed earlier, you can't do transactions with yourself unless you do it as a tenant in common, but you then can't, that's only to purchase properties from arm's length transaction, other people. Let's say you're a real estate agent and you want to buy this property, but you're going to buy it with your solo 401k. You can do that, but you can't really make commission as the realtor then, because you're an unqualified person. You're an unqualified person at that point. So you can't double dip there using a solo 401k. You can flip properties in solo 401ks, but that makes it more of an active income where you'll have to pay some taxes. So kind of the best practice and industry standard is don't flip properties on an ongoing basis. If you do 1 or 2 a year, it's probably okay to do it in your solo 401k, but it's better to just buy and hold properties in your solo 401k. It's going to make the paperwork easier, and it's going to be less burdensome when it comes to doing taxes, determining whether it's passive or active income. And active income, you do have to pay self-employment tax on when you do the distribution. So again, you can flip properties, but it's not really recommended. Again, bullet point number 3, you cannot purchase property with 401k and your personal money unless you have a tenants-in-common written partnership. But most people don't, if they're going to go to the partners, it's usually with other relatives, but you can't go in by yourself and just have half and half without that tenants-in-common. And as mentioned earlier, the most likely scenario buying a property is you do have a mortgage that is through a lender. And again, that mortgage has to be a non-recourse loan to you, where it's just all charged to the solo 401k. So that's kind of the major point of the main points of the presentation, but I still have some best practices and tips that I found throughout the years talking to clients and asking questions that I'm kind of just going to go over. Just to kind of do the preemptive part where we start doing our questions. So travel related expenses, again, if you're having to travel to visit your property, that's a solo 401k property. You can't reimburse yourself with those travel expenses. So again, that goes back to that commingling of funds where you're spending money of your personal account. If you try to reimburse yourself, anytime money comes out of that solo 401k, it's going to create a taxable event and you're going to have to pay that 10% on it. But most likely, if you're traveling for that, you're just going to have to expense that out of your own pocket. If I or my business have a primary residence, can I sell it to a solo 401k? No, you can't. That's that prohibited transaction. You know, the sale, exchange, or lease of property between the plan and a disqualified person is prohibited. So you're not able to do that. One thing, as depending on what your property value is, properties usually appreciate over the course of time. As you get closer to that retirement age, you may want to look at maybe liquidating the properties, because let's say you have 4 or 5 properties in your solo 401k account and you're about 70. At age 72, 73 in the current tax law, you do have required minimum distributions. So at that point, you'd actually be forced to kind of sell a property. So you'd have to cash out one of those properties to get cash, then to take a required minimum distribution. So at that point, as you get closer to those R&D age levels, you're going to want to look at maybe liquidating those properties. But when you do liquidate the property, you're going to have all that appreciation from the day you bought it to the day you sold it. So you should have a pretty substantial tax-free gain until you start pulling it out of the retirement account. Jeff, I'm seeing your question of if you're over 59 and a half, would there only be tax event, not a penalty? Correct. Just as in any retirement account, once you hit 59 and a half, you can withdraw those funds. If it's a solo 401k that's not a Roth, you will just pay the ordinary income tax on that. You won't have to pay that 10% fee. I think at that point, I'll probably just turn this over to an open forum if you have any questions regarding this presentation or want a little more clarity for the next about 10 minutes or so. One of the questions that I'm seeing is in the chat is you can rent the property out. You just can't rent it out to kind of your grandparents, parents, children, adopted children. You can rent it to pretty much anyone else but those individuals, and you can't rent it to yourself.
Hey, Pete.
Yeah.
Hey, this is Charlie. How you doing, man?
Doing well. How are you, Charlie?
Good. In essence, the solo 401k really acts as a repository for your properties, generally speaking, yeah, since it's a 401k.
Correct. And for these ones that you put in there, yes.
Okay. Yeah, because basic rule of thumb is, like you said, keep everything, make sure that nothing's commingled, and then try to keep it to a minimum, right? So you're basically using it as a repository until such time, like you said, until you're ready to liquidate a property or for creating some of those funds for the distribution. Yeah.
Correct. Yes.
Okay. Okay. Great. Thank you.
Yeah, you're welcome. That's real early where you're at, Charlie.
Yeah.
glad you can make it. I normally see at
Yeah.
the noon one. So
yeah, my chickens aren't up yet. They all stare at me in the morning like, "What are you doing up so early?" Great seeing you.
Yeah.
Pete, if I understood you correctly, then there's no UBIC tax in a solo 401k either?
Correct. There's no UBIT tax for a solo 401k. So you avoid that tax as well by using a solo 401k if you have to take out a loan to pay for some of the property. John, you had a question saying, is there any way to harvest any losses in a self-directed IRA or Roth? Could you add a little more insight on what you're wanting on that, John?
Yeah, for example, purchased 2 houses in the self-directed Roth several years ago and ended up losing on the transaction. So I'm just curious if there's any way to harvest any of those losses.
Yeah, so if you were able to, kind of general terms, if you bought an asset and you sold it for less, you would have a capital loss, and then that capital loss, you could offset other capital income that's made during that year because of the Roth aspect. Because when you put money in as a Roth, anything you contribute as a Roth, you can pull out. It's just the amount of money that you make on it. That's what stays in there till 59 and a half or 6 years, depending on when you start the Roth age-wise. So if you had other, if you had a normal 401k or a normal IRA, you could transfer some of those into a Roth and use some of the losses to help offset those gains that you would receive there to kind of have a neutral tax effect in most cases. So.
Hey, Pete, forgive me if I missed some of this, but when you have an LLC attached to your 401k, would all funds then transfer through the LLC once that documentation's been done for, quote, a loan or operating agreement? Would that then go through the LLC, or would it still all funds go directly in and out of the 401k plan?
So the LLC would open its own bank account, and the funds would go in and out to that LLC bank account, but that LLC bank account rolls up into the solo 401k. So that's it's kind of an extra additional layer. So it still gets the same treatment as your solo 401k, but it's the LLC in the solo 401k. So that LLC will have its own bank account.
Okay, thank you. And then can the Roth money, does it need to be invested completely separately, or can it work in conjunction with monies from the 401k, and how would that happen if that's possible?
So it depends on how your solo 401k is set up. You're probably gonna have a Roth one and then a traditional 401k, solo 401k, and you would probably just use one of those accounts to buy one transaction, most likely, I believe, on how your setup would be.
Okay, thank
Yep.
you so much. Appreciate it.
We may have to follow up on that because I think that's what you're asking, but.
Yeah, that's what I was asking.
Okay.
Yeah, thank you. Thank
Yeah.
you.
Good. And again, I know I mentioned at the very start, but you still have time to the end of the year to set up a solo 401k. You don't have to have the funding done in 2022, but the legal work, the entity creation, all that needs to be done by 12/31/2022.
Hey, Pete, good morning. This is Alex. Just to
Alex.
be clear, can you buy non-real estate business with your 401k dollars?
Alex, let me get back to you on that one. I'm leaning towards more of just like a normal business.
Yep. Or it could be, doesn't have to be a hard real estate asset, could be a management company or construction business, or that's the first thing. Can you take some of those funds to buy those type of businesses?
Off the top of my head, I want to say I don't think you could from a 100% purchase standpoint. You could take a loan out on the solo 401k of up to 50,000 and do that, but I don't believe that's the type of investment you can do outside the solo 401k to buy companies.
Okay.
So, but let me research that one specifically, and I can post it in our Discord.
All right. Thanks, Pete.